There are no bad markets, just bad strategies. Hi, my name is Ahmad Ashrafi, and I want to teach you how to become a better real estate investor. I want to tackle this notion of a bad market. Right now, there's a lot of people, and I hope that this video lives past this time, but there are times when people say office is bad post-COVID, or real estate is going into a depression, or real estate is in a crisis because interest rates have gone up. That notion of bad markets is completely erroneous. And it's very amateurish to say and paint with a thick brush that everything is bad or good. It's never good and it's never bad. It always depends. So when you look at real estate in a different light, that there are no bad markets, there are just bad strategies, you become a little bit more savvy into going deeper. Real estate is hyper localized. So one corner does not equal the next corner. An office building does not equal the next office building. One developer is not the same as the other developer. So let's tackle or change the notion that there are bad markets in real estate or bad products in real estate. Let's forget about that type of generalization because that makes us miss the gems. I want to address some common misconceptions about market conditions. One of the biggest or the most important key indicators of markets are market cycles. Usually people think that the curve that we've all seen is a curve that goes, it's sort of like an S curve where we see expansion, hypersupply, recession, and again, growth. These are occupancy levels. So many people don't understand. They think that it's actually price, and it confuses people. Why is it horizontal? But it's actually occupancy. And real estate has a big challenge with occupancy and time. A building and supply cannot be built overnight, so it has a lag. And that's why there is, the real estate cycle is no different ever. I think a lot of people think that, oh, this time it's different, or it's going to be different, or it's going to be like '08. And I think that a lot of people make that common misconception about market conditions. Furthermore, I want to throw some light and perhaps some criticism at the news. The news evermore has become a clickbaiter, a sensationalist, because it's looking to grab your attention. It no longer sells information, it sells news. Therefore, the news will always make things worse as they are or better than they are. Just look at the stock market. Every day it either sinks or swims or surges, really is the word they use. So you cannot base yourself on what you hear. These are also misconceptions about market conditions. The media also influences our investor behavior because there is one asset that is being sold at 98% discount doesn't mean that all assets in that asset class or in that product type are going to have the same thing. It's an oversimplified way of extrapolating one event to the whole market. As a savvy real estate investor, you should never paint with broad strokes anything in real estate, because as I explained before, real estate is hyper localized, and by having that myopic point of view, you're going to miss out on the best opportunities. One thing I tell my investors all the time is emotions and investment don't mix. So be careful with using emotions or perhaps influenced narratives to make any decision. Let's go back to the 4 phases of the real estate market cycle. I think this is the most important concept that you can get from this podcast, and at least to become a better real estate investor. The first phase is called recovery. The second phase is called expansion. The third phase is called hypersupply. And the fourth phase is called recession. In every part of this real estate cycle, there are opportunities. Just because we're in a recession, it doesn't mean it's a bad market to invest. Quite the contrary. In a recessionary market, we have a little bit more vacancy. Therefore, building or supply of real estate is being stopped or not coming to the market. And it's in fact one of the best times to come in to the market to build new product, because your product will catch the market or be delivered to the market and absorbed when you get into a recovery or perhaps an expansion phase. A lot of people think that because we are in a hyper supply state, that more supply should be given. And this happens to all human beings. I like Aristotle's quote that we are emotional beings that think sometimes. Therefore, there are markets where greed can overtake your decision making, and that's a very dangerous moment. So even though you see that prices are peaking and they're going higher, and you think that you're going to catch the highest price, that's when you might be caught with what we call internally a hot potato. A price that you pay is too high, and then the market softens and you get stuck with a high cost or an inventory with high cost. Real estate is no different than running a fruit stand. If you look at it simplistically and you think of your assets as inventory, you will start to make the same type of connections of how you manage inventory, and especially how you keep your costs low. There are very interesting strategies in down markets, especially as a real estate investor. Real estate investing means placing money, placing capital in the lowest risk position that generates the maximum return. A lot of people think that because we're in a down market, it's not the right moment to invest and we should wait until the market picks up. But when the market picks up, it's too late. Usually you'll be caught with a hot potato again. And therefore you follow the cycle. Your own cycle of investing always becomes repetitive, and perhaps your returns will be a lot lower than they would be if there was a savvy investor. I recall at Infinity, when interest rates were very low in the years 2022, that investing into multifamily was, especially development, was better than investing into value add strategies where you acquire an asset. Because at a low cost of capital, it was cheaper to develop than to buy an asset that was already built. Then the market shifted and changed, and around 2022, the market shifted that new development was more expensive than acquiring product. Therefore, our thesis moved to where we would lower our exposure and have a lower basis. Maybe you're starting to see the trend here. Cost in investing is everything. You should never overpay, because that's when you get burnt. When you buy at a low price or at a comfortable price, you have multiple exit avenues. You can maneuver and have a smarter approach to investing. So you can find strategies that are actually more beneficial, or at least more risk adjusted, than in up markets. Let me go a little bit deeper into what a value add opportunity is. I think that this is a revolutionary concept that everybody knows, but I think there's little understanding still. This value add strategy is very common in down markets when previous investors or previous owners get into pressure to sell their property. Their property is underperforming for XYZ reason, and a new fresh investor might be able to correct that by finding properties that need improvement. Let's say that the previous investor had a property for 10 years, maybe 20 years, depending on how long they've held, and their maintenance costs are starting to become a little bit high. The building doesn't look as fresh as it used to. There's a lot more competition in the market that has driven the prices down, or at least stagnated the prices. So a fresh investor might be able to say, a new buyer might be able to look at a property and say, we can create a value add. It's a forced appreciation against the asset where we take this old asset, make it better, improve it, and with the new improvements, attract a higher paying renter. This is a way to increase the value of a stagnant market. If you think about it, when you force appreciation, market conditions are less important. They're always going to be important, but they're less important. One of the favorite stories of every investor is to find distressed asset acquisitions. This is the moment when in down markets, people that did perhaps they were over ambitious or they had a problem with their perhaps a good asset, but bad financing or bad finance structures start to get into a distressed situation. This is a very exciting opportunity for a new buyer to acquire something at a low basis. Again, going with the cost is number one consideration when you invest. And this has the same thing with opportunities in foreclosures and perhaps even short selling. So how to navigate these transactions? You shouldn't invest into assets that you don't have good knowledge. Here, I want to also say a very important part about patience and capital reserves. Real estate is not a liquid market. Real estate investing is not the stock market. It's harder to make bad decisions, but there still can be made without patience. A lot of underwriting happens to look at possible scenarios for a building. And most likely, the business plans are 3 to 5 years. If it's let's say a middle market opportunity or a middle market asset, this is a $5 to maybe $50 million asset. Or if it's 50 to above, it might be a 5 to 7 year business plan or maybe a 10-year business plan. Sometimes it doesn't hit. Sometimes market conditions change, and instead of the 3 to 5 years, it's going to be 6 years or 7 years. Investors need to know that it's for their best interest to hold. This is something that I really did not appreciate about the model, or I think the model there needs to be innovation in how fund management happens. Traditional funds have a 10-year lifetime, and because they have that type of lifetime, or 7 years or maybe 5 years, because they have the lifetime, sometimes they have to release assets at the wrong time and shoot themselves in the foot and their investors and losing money. As a private investor and family office, this is not what you want. You don't want to get into these funds that restrict their use of money and how they're supposed to buy and sell and operate. One of the things that I look into and why we created Infinity was because we're looking to make the right decisions at the right time with the right people. Not necessarily do we need to confine to a set of rules that if the market change no longer applies. And second, the need of capital reserves. Capital reserves is a tricky subject for a sponsor because as a sponsor, you need to have the lowest cash drag, which means the capital reserves need to be at this minimum so that your return is higher. The capital reserves is something that we always think there should be a margin of safety. But in times when the market is changing, like it will always change, the cash-rich sponsor will always prevail. So having these capital reserves is very important. And at Infinity, having sponsors with perhaps deeper pockets or a little bit more of assets under management can all be a comfort, because with capital reserves, you're able to push projects to the finish line. So what the other side? What are strategies in hot markets? What are things that you can do? I spoke a lot about the down markets, but what about the hot markets? When the real estate cycle becomes prices are rising, what do I see as important? First of all, keeping the same notion of never overpaying. A hot market can be very alluring. It can entice you. It can seduce you, but most importantly is to never overpay. So this, I would prioritize off-market deals in hot markets. Off-market deals means talking to people, direct owners, and trying to buy their asset without them having put it on the market. It takes a lot more experience. It takes a lot more groundwork. It takes a lot more walking and perhaps getting rejection, but it pays off, especially in hot markets. We've been able to acquire off-market opportunities where the owner wasn't aware that they wanted to sell, but when we approached them and we brought them an offer, to us it was way below what we thought was worth it, and for them it was way above what they were expecting to get. It was a win-win on both solutions, and in an up market, buying at a low basis really increases your returns, and your investors will be happy for it. We've always prioritized in having these relationships with people and building our reputation as someone that would buy properties consistently. So being in the market, always talking to different sponsors and developers, and being active has paid dividends by being the first ones to get to see certain opportunities or even knocking on doors, like I mentioned before. To be a good real estate investor, you need to network. This is the key. There are no bad markets, only bad strategies, but you can only execute strategies if you know who you're working with. So constantly talking to people, growing your network is how you find deals before they hit the market, and also having a better opportunity or better pipeline. The other thing that's very interesting, and it applies to down markets and up markets, is creative financing. Never should you enter this market if you don't understand finance or debt. Financing is critical to real estate, and probably one of the greatest superpowers of real estate is the ability to leverage. Like it's an incredible superpower, but Spider-Man is also an incredible responsibility. You need to know what you're doing with leverage. And understanding leverage is one, but then working with real estate professionals to find creative financing, to find the ideal financing. This is now that there are tons of debt funds and banks and other private lenders in the marketplace, you can find a solution that works perfectly or better for your project and others. And there are some people that you should stay away. That's why it's also the importance of networking. Certain debtors, certain debt funds have a loan to own strategy. They want your asset and they will make it hard for you to have it. Sorry. They will make it hard for you so that they can get the asset. And there are other friendly, of course, funds that perhaps are easier to work with. So understanding financing is one, having creative financing is two, and then knowing who you're working with. You can also explore options like seller financing and leasing options. I think that these are things that in up markets, it's a little bit more of a buyer's market. Or perhaps the seller might be more willing to sell at a higher price if they're giving you a deal or somehow financing. So I think always explore a seller solution. The other thing in up markets is, as we said at the beginning, don't paint real estate in broad strokes. So if there's an up market in the gateway cities, there might be a less of a trend or a different type of cycle in secondary cities. Even not all secondaries act the same. So also diversifying your geography as an investor is interesting. And in up markets, usually it's easier to make money in secondary and tertiary cities over primary cities. So identifying these overlooked market segments can be a great source of return. Lastly, I want to reiterate what we've I want to reiterate what we discussed at the beginning. There are no bad markets, there are only bad strategies. And you have to develop adaptability in your investment approach. Infinity is an expert at this. We have tools and techniques for market analysis. We have data analytics platforms. We have AI-powered insights in real estates. We look at economic indicators to watch, and we balance data with on-the-ground insights. All this so that we can be adaptive. We're not looking to have a thesis that works for the rest of our lives. We're looking to think, with this data, what is the right thesis? It's the opposite principle of most institutional firms. Most institutional firms have a top-down approach to investing, which means they look at a market that is rising and invest or pepper into that market their thesis. There's a saying that rising tide lifts all boats, and that's basically their thesis. And institutions are able to do this because they have great amount of capital to allocate, and this is an effective strategy. But it's also an average strategy because you're working to the average. All those rising boats will rise, some more than others, then you get that average. When you work with someone like Infinity, we have a bottoms up approach, which means we look at the asset, then we look at the market, and then we look at the investment, and then we look at the team. Like we're looking at every single part of the asset from bottoms up. And our thesis is according to the opportunity in hand. Does this work? Does this not work? Is this going to be exceptional? Is this a 9 or a 10 in our scale? And then with all the tools, we have an investment committee that looks at every possible alternative to make it safer and to also reject the investment. Now the question is, if there are strategies of down markets and then up markets, how do you build a portfolio, or how do you build an investment that makes the most sense? And I'm going to quote Ray Dalio, or at least use the name that he uses for his strategy, which is called the all-weather. And I'm going to apply it to real estate. The number one reducer of risk is diversification. Therefore, as an investor, you need to think about how you're spreading investments across different markets, different geographies, different product types, different sponsorship, different timelines, balancing between high growth and stable markets, balancing property type diversification. So have some office, have some industrial, have some multi, have some retail, maybe hotels. All of this diversification will reduce your risk, and having that mix between residential, commercial, land, industrial investments are very positive. Obviously, there is pros and cons of each property type, but by being diversified, you'll reduce the risk. This diversification strategy you can also combine growth assets and also cash flowing assets. Our private credit fund, which was a strategy born by high interest rate environment, is one that satisfies the need for people that need cash flow. And our equity strategies are those looking for a greater appreciation. Personally, and this is my opinion, obviously giving my legal disclaimer that all of this is my opinion, I believe that you should invest, even though this all-weather strategy is very good because it minimizes the risk and you'll get an average return, and you'll be exposed to this private sector, private real estate sector, private equity real estate sector. Perhaps it's not the best for you. So as an investor, you need to, knowing yourself, knowing your needs, knowing your objectives, your risk tolerance, and the time you have, you will be able to find a better balance between risk and reward. Perhaps reducing the risk so much and diversifying so much, the reward becomes unsatisfying to what you're looking for. Perhaps not enough cash flow, not enough appreciation, and the work done does not justify all that. So to recap on the main point, Success depends on strategy, not just on market conditions. I encourage you to develop that market analysis skills and keep on learning. Never do we think at Infinity that we are experts. We still feel that we're students, and we're adapting our real estate investing with every day that we learn a little bit more. Thank you everyone for listening. Please subscribe, leave reviews, and I'll see you on the next one.